markets on the precipice of the biggest collapse we've seen since COVID or the global financial crisis? Did Powell finally cave to the unrelenting pressure from the Trump administration to cut rates? And what does the new Fed stance mean for the economy and markets? All that and more on today's After Hours. Welcome to After Hours at TradersPost for Friday, August 22nd, 2025. I'm one of your hosts, Tom Hartman, joined tonight by Peter Bad Guru Hartman to break down the madness. After Hours is your go-to live stream for sharp, trader-focused market commentary presented by TradersPost, the ultimate automated trading platform on this planet. But more on that later. For now, I want to ask Peter, were you aware of just how close we came to a major financial collapse in financial markets?
Yeah, I mean, Joe Biden in office was just doing such terrible work. And I thought, if this goes on 4 more years.
No, Peter. All right. You take off your past hat. We were on the precipice today. In fact, if you've been paying attention to markets, NASDAQ, S&P, Bitcoin, all of these guys were taking a nosedive into scary territory. Hands up if you thought that Bitcoin could maybe like close at 105 or even lower today. Hands up. Okay, not me at all. So, all right, I called you out, Peter. I didn't think it would actually head down there. You know why? Because I have faith.
Faith?
I have faith that markets always go up. Number go up. Number go up.
Faith, is that what you're proposing, that people have faith?
Faith is the substance of things hoped for, the evidence of things not seen.
I don't know what that means, but I prefer logic.
Well, if you want to go by logic, let's go ahead and take a quick look at Tier 1 Alpha over on X, who was actually talking about the zero DTE effects that we have on markets. So I just want to point this out here. So zero DTE, this is zero date to expiration options. And we're going to be taking a look just quickly here at the volume of these options. All right. So if we take a look here, this is on August 6th. Tier 1 Alpha says here the dopamine flow is in full effect. SPX zero dated options hit a new record yesterday at 68.52% of relative options volume. That means there's a crap ton of volume happening within the option space, within the shortest level of options you can have for now. I'm sure they can have hourly options that are going to happen pretty quick. But that means people are betting either up or down based on the close of the day or like one day out. Pretty interesting. More interesting than that was on August 6th. 7 hours ago, so earlier today, 69% of the SPX contracts traded yesterday were zero DTE, marking a new all-time high right before Jay Powell's closing ceremony speech at Jackson Hole.
Question.
Query. Yeah, go ahead.
Why does this matter?
This matters because the amount of volume. This is as close to YOLO trades as you can get. This is zero dated options. That means instead of someone betting that the S&P is going to go up, $5 in the day, they're basically taking a bet that if it does go up $5, I want to make 20 times that, 100 times that. I don't know the exact numbers, but essentially it's a GameStop level of profit you could be making on the zero dated options.
But why do people think that now? Like, why is this all of a sudden taking off?
Well, you'll see here on the chart, you see here that Robinhood launched SPX options back at the beginning of the year. So it became even more accessible to retail traders. And before that, OPX was just, the zero DTE was just increase it in popularity because an options contract is cheaper. An options contract basically gives you access or control over 100 shares of the underlying. So 100 shares of the SPY, SPX. But if you don't have that amount of money, options are way cheaper. Plus, zero-dated options are essentially as cheap as an option can get. Because normally, if you want to control 100 shares of the underlying and you want to control that, let's say for the next 3 months, that you'll have to pay for that. Someone is taking the other side of that bet. They're betting, if you're betting that over the next 3 months, the S&P will go up by 2%, that has a higher likelihood of happening over 3 months than it does in 1 day. And so you have to pay for that. You're paying more for that bet because the other guy on the other side of that bet wants to be, or gal wants to know that that the risk is offset. But when it comes to zero DTE, it's the same contract. It's the same options contract, gives you access to the same 100 shares, but you're expecting that move to happen today. And so the person on the other side goes, okay, fine, I'll sell it to you for peanuts because I don't think it'll happen today. And if it does happen, oof, you can make a pretty penny. That's like betting on whether Logan Paul will win the Tyson fight while the last punch is being thrown.
I'll take that bet.
Yeah. Now, what this does is that it makes the markets super fragile, right? Because of gamma, right? So these bets, they're asymmetrical. You're not betting on whether or the payout that you have to get. Let me put it in this way. In that Logan Paul Tyson fight, imagine someone gives you in the final punch where Logan Paul, just imagine Logan like knocks out Tyson. In that final punch, if you're taking the opposite bet going, I think Tyson's going to win this fight. And the person's like, okay, fine, I'll give you 1,000 to 1 odds that's the case. And as that punch is getting closer and closer and closer, the odds are getting better and better and better and better. Well, what happens is that if Tyson does win, and the odds go shift dramatically to his side, well, the guy has to pay out 1,000 to 1,
right,
to a ton of people. Well, that's rough. That's gonna move markets. That's gonna a lot of people are gonna be in trouble. Not the people owning the options; they're gonna make a boatload of money. But what happens is that there's this reflexive loop where a bunch of things needs to happen. So, for example, in the stock market, with all this zero DTE options being purchased, if it turned out that the stock market fell, that means there are a bunch of people who are short puts that would need to cover. A bunch of people who are also short stock. So that means the market participants and market makers would have to sell the S&P. As the price of the S&P is going down, they have to sell in order to hedge their positions. And as it's going up, they have to buy in order to hedge their positions. So Cem Karsan does a much better job of explaining this idea. And I just wanted to spend a little bit to paint this picture because we were 2 days ago on the verge of potentially absolutely major collapse. And it's important that we know that because that collapse might still be around the corner. The volume for zero DTE is still high. And it could still happen. All right, so let's just take a look at what Cem Karsan is saying here. You'll let me know if you can hear.
Make money in both scenarios.
Speaking of the stair step, the last couple
and make money in both scenarios.
Speaking of the stair step, the last couple times that we spoke, I believe that was still your running kind of prediction, and emphasis on prediction here, folks. That after August OPEX going into September, maybe even after September is when we would start to get that stair step down. Do you have any kind of update on what your crystal ball says? Because VIX expiration is tomorrow. We had the SPX expiration on this last week. What are you thinking? What are you seeing?
So, all right. So when he's talking about expirations here, remember, expiration mean as we get closer to expiration, the options that people purchased diminish in how much they cost, but increase in how much they pay out. All right?
Of course.
Because if you're paying $10 for the option at the beginning of the week for a bet that the stock market will move 1%, if you take that bet on the last day of the week, that option might only cost you 10 cents, but the payout is the same. right? So if the $10 option would have given you 100% return, so you would have made $10, it would have given you $20. At 10 cents, now it's a 2,000% return. So because more and more attractive, more and more people might buy in, and if the market does do that, more people have to be paid out. All right,
But
so
it's still very unlikely that the market will do that. This just encourages degenerate gambling.
well, watch your mouth, okay? The people are allowed to provide liquidity to the markets, and there's all kinds of usefulness in order to do that, and people are able to create all kinds of products in order to generate yield that you can't get normally in these types of ways. Can it cause the collapse of the entire financial system in a freak accident all at once? Sure. But what price are you willing to pay for freedom?
Okay.
Year. This is either number 1 or number 2 for the most dangerous week. And that's true historically. But it's also true increasingly because of the issuance of structured products and hedge fund positioning and what's happened this summer.
Let's keep going up.
So yeah, like that, but that's this week. We're not talking about this month or next 3 months or 6 months or 9 months, right? And so if you say, Jem, what's people have been asking me this last several days, what are the most highest odds for the next week or two? What are the highest odds for the next 3 or 4 or 5 weeks? The answer is 60-40. Odds are we go down. I don't think it's a vol event. I think that's a low probability that we get some big vol explosion. Market down, vol down would be the most likely path. But to be clear, what does that mean? That means, in the next 2 to 3 weeks, 3 to 6%. All right. And if
3 to 6% chance that the market falls is what he's saying. Oh, sorry. 3 to 6% that the market might fall. The S&P might fall 3 to 6%. This is what he's saying. Could happen.
Down 3 to 6% in the next 2 to 3 weeks, especially on the long, 4 to 6% side, maybe a little bit on the higher side, 4 to 7%. You're more likely to then activate the significant risk that exists on the put wing. This is that gamma we've been talking about. The short gamma, by the way, not the long gamma. The short gamma and short vega of the SEP OPEX structured product input.
Just to translate, so basically he's talking about the idea that if there's a bunch of people who've sold these options, that's betting on this down market move that they don't think will occur. So they're short the puts. Well, what happens is that if the market does go down, as the market goes down, those puts go up in value. So they have to hedge that by also selling the market. Then as they sell that market, the market goes down because they're selling. And so the puts go up in value again. So then they also have to sell the market. And you have this process where it happens again and again and again and again. And the market with no news, even worse if there is news, can fall dramatically as this hedging occurs because of the gamma. Because the further it goes down, the faster the option goes up in value. So if the market goes down, let's say $1, and that option goes up by $1, let's say they make it easy. When it goes down $2, it doesn't go up by another $1. It goes up like by $1.10. And if it goes on again, it goes up by $1.30. And it goes on again, it might go to $1.70. And it increases faster and faster, that's the convexity, as the market moves. And so more and more and more the selling can happen. And so you can have this massive downwick, which is what we saw in the COVID drop. We had this massive down. People weren't hedged to the downside. They scramble for access. People who are short puts, they have to cover. All this sort of thing happens that causes a dynamic where the price just craters. And you get the stock market drop 50% like that.
And that's what has a low probability of happening?
Well, there are times during the year where people are not suitably protected to the downside because of options expiring. Remember, these options expire. So if you get close to the expiration date, people might be rolling options. They might not have it on. And so if there is a downdraft, then they're not covered. So then they have to scramble to go buy puts in order to get covered. By then, those puts are already high in cost. Instead of buying it when the market was at the top and they could buy it for $1, now they might have to buy it for $100. And they got to buy it because they got to cover $10 million worth of stock. So they got to buy these puts. And then as they buy the puts, those puts go up in value. And as they go up in value, more hedging has to happen in order to sell the market. And as more people sell the market, they have to buy more puts. So it's like this crazy situation where you can get this reflexive loop to the downside. Anyway, so that's a great point there. Cem Karsan is fantastic. You got to go take a look at it. Remember, he was talking. This 2 days ago, he was talking about the potential for the market to fall 3 to 6%, and we were at the edge of that. How many people over the last week were looking at the markets, going, "My God, we're going to go so much lower. We're going to fall dramatically on the S&P. We're going to fall dramatically on Bitcoin," and we're seeing that fall, right? Until we reach today's volatility point. But before we finish off on that, I just want to play this last clip from Cem. That's like, look, well, the speaker, he makes a good point as he articulates the context well for the question.
Than to pick up down at any given moment.
God damn. You know, Jim, every time I talk to you, I just realize how stupid I am. So thank you for that.
No, sometimes you've seen speaking of distributions, the distribution of sometimes being too smart is also sometimes it's easier just to YOLO calls when you're in the right environment.
Man, it works for some people. I swear to God, some of these guys sharing their Wall Street bets screenshots, I'm just like, it pays to be a moron.
That's how you made money this summer. I want to be clear. That's how you made money this summer. That's how you made money. And there are incredibly profitable convex bets. And by the way, options themselves are incredibly useful for not just hedging or playing distribution, but making bets.
Yes.
They are bets, and they are the most precise way to take convex bets. And there are times where, particularly in this environment, given the flows, that you can make tremendous convex bets with relatively little risk based on environment and flows. So you don't have to be that smart necessarily. You don't have to know all this stuff. You don't have to be an expert in this stuff to understand the value of options, start using them in a constructive and profitable way.
All right. I want just to leave you with that part there, because a lot of people think that there are dangerous things to options. If you don't do them in the right way, you could end up losing your home. Totally true. But because you can lose your home, the upside is also there. You can gain a new home, right? if you bet correctly. And when you are buying options, if I could give any advice to anybody, it's not financial advice, but this is what I follow. As long as you're just buying options, you can never have a risk of ruin in that way. Because when you're buying an option, whatever price you pay for that option, that's your price. Either the option pays off and you make money, or it doesn't and you lose whatever you put in order to buy it. It's the people who are selling options that's a big problem, especially naked selling for options. So if you're confused about it, you don't know anything about options, but you want to dip your toe in and you're just worried about it, the golden rule is only buy options. Whether puts or calls, only buy them until you feel more comfortable dealing with the option space. All right. So this morning on Price Action Live with me and Mike, which you guys can take a look at every morning, actually every morning except Monday, where we're trading prop firm accounts using the TradersPost software in order to account scale and do all kinds of crazy funky things in order to be able to have more control over our trading. Definitely go to traderspost.io in order to sign up for a trial, just so you can see what it's like. But also, so on Price Action Live, we saw firsthand the markets just this morning, it dropped and then rallied absolutely massively the moment that Jerome Powell's speech was published, because Jerome Powell spoke at Jackson Hole today, which he does every year. It's the great, should be a holy event. Should be a day off of work. As people, keep the markets open, though. Keep the markets open when High Priest Powell speaks. And what's great about it is that they released the speech in writing beforehand. Happened exactly, I think it was at 10 o'clock or 11 o'clock. Which is great. The algos get it. I mean, before a human being has time to read it, the algos are parsing every word. They're checking to see how many times he used the word with this time versus other times. And, you know, usually it's very minute details, but this time it wasn't minute at all. He had quite a bit to say, and it caused markets to absolutely rally up. But it could have gone down, right? So let's just go ahead and take a look at Powell's, my two favorite part of Powell's speech.
Wait, your two what?
My two favorite clips from Powell's speech today at Jackson Hole, because it was just absolutely. I never would have expected to hear this sort of thing from Powell. Well, I guess I should have expected it, but that it happened, I was like, wow, amazing, because the market was going down, and if ever Papa Powell was going to come in and put that Fed put into place, it needed to be today.
Papa Powell.
I didn't know just how on the edge we were. I mean, I should have known. I always know that there's a risk of a gamma collapse because of zero DTEs, but I didn't know like we were really on the edge of it. But Powell seemed to know, because he came out and whoop, he made the rounds. All right, let's see what he said here. So first, he's going to talk about the Trump tariffs.
Inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks.
Okay, so I'm going to put that on a t-shirt. The one-time tariff price increase, the inflationary effects, the one time might not happen all at once. Okay, so the inflationary effects might not happen all at once, but they will be a one-time effect. Now, what a beautiful and delightful version of Fed speak. Fed speak is a type of conversation, a type of way that they talk, which is like, it's
You should make a translator.
what they want is for when the Fed speaks, what the Fed is trying to do with forward guidance is trying to make the markets read between lines that they come up with. So they want you to come up with it in your own mind and act accordingly, but with enough doubt that you did the right thing, so that they don't come out as seeming like that they like pushed you to do it. They don't want to push you to buy the market. They want to say stuff in such a way that you go, that seems bullish, and that you buy the market, so that they can come back later on and people go, hey, you juiced the market up. No, we didn't. All we said is that we thought that the one-time cost push inflation of the Trump tariffs might have long and variable lags and happen slowly over time. So what does that mean? I think we've been very clear as to what we mean. I think we're very clear as what we mean. So the markets heard that and they're like, okay. So he's saying tariffs are inflationary and that those inflationary effects might be consistent, might happen over time. This is that whole transitory inflation. I'm like, hey, we're going to have inflation. So then you go, okay, if you're saying that inflation might go up, then wouldn't we need to raise rates? Right? Inflation goes up, we should raise rates in order to cool the economy. No. So let's listen to the second clip where he talks about the monetary policy that the Fed is going to implement.
Ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenge.
Okay. Risk to inflation are tilted. Oh, I love the Fed. Tilted. It's a little bit to the upside. Don't go crazy. It's going to be inflation, but it's not crazy. It's not going to triple the price of eggs. I mean, it might, but we're not saying that's going to happen. And risk to employment tilted to the downside. You know what that means? Downside employment means up in unemployment means recession, means lower growth, means less spending. So he goes, so what do we do here? The Fed mandate is steady inflation and steady employment. So full-time employment and stable prices. That's basically what it is, but they translate it as stable inflation. So they're always targeting this 2% inflation and unemployment that stays non-volatile. There's always a certain number of unemployed people they need in the markets, what they call slack, in order to give flexibility to the employment structure. Because the idea here is that if you have, well, let's just pull it up here. Supply and demand here, right? Supply and demand. If supply goes down, prices go up. If supply goes up, prices go down. If demand goes down, prices go down. If demand goes up, prices go up. But the Fed is in a situation right now where supply went down, so prices should go up. But because of the growth issues and the mass deportation of the illegal immigrants, demand went down. So both demand and supply went down to almost evenly, so that the inflation sort of like stayed steady. So we never got the full-on inflation stuff that we were worried about because, you know, the economy is suffering. Growth is suffering. So it's like it's a crazy experience for the Fed. What do? Do they raise rates in order to cool inflation, or do they cut rates in order to stimulate growth? So what they decided to do, and we're not going to play the whole thing because it's a nice half an hour. Go take a look for yourself if you're inclined to watching Fed speak, which I watched this video 3 times already. I love it. Is that they go, okay, we're essentially going to have like this sine cosine curve, right? This sort of like mix of sometimes inflation will be a problem, sometimes employment will be a problem. And what they'll do is they'll play whack-a-mole. If inflation's a problem, theoretically, they'll go ahead and raise interest rates. And if unemployment is a problem, then they'll go ahead and cut rates, right? So that's basically what they're saying, that, look, forget about the 2% inflation, forget about the fix, forget about predicting whatever. We're just going to go ahead and deal with whatever we need to deal with at any given time. And so since inflation is not the big problem right now, because they're not seeing the big push in inflation, but employment is, well, rates got to get cut. Rates got to get cut. And that is what they're probably going to do, because, right, he didn't come out and flat out say it, but the markets are pricing in at least one rate cut. I know the poly market bet for a 25 basis point cut in September 17th, went up by 21% to 86% probability, and that matches the 86.9 or whatever percent probability on futures for financial markets. So reading between the lines, reading the Fed speak, basically everyone's like, hey, rates are going to get cut. And if rates are going to get cut and they want to goose the economy, well, stock market up, baby. Let's go to all-time highs on the Dow. Let's get the near all-time highs on the SPY. Let's get a big God candle here on NASDAQ. We got Bitcoin jumping up from the bottom. Just a jubilant move up. Praise AI, praise the empire as everything goes up and to the right. Even gold caught a bid. And the dollar fell, guys. Guys, the dollar fell. Remember, we've been talking about the dollar being nerve-wracking here. Let's take a look at the dollar. the dollar here was rising. It had been rising since what is it over here? This is August 13th, right? We had this up move in the dollar, very nerve-wracking, which coincided with the drop in the stock market and in Bitcoin. But now that basically completely reversed, and now we're back down below the volume weighted average price, headed towards our beautiful 97. I think it's 97 on the 97 on the Dixie, which would be hella bullish for equities. All right, this would be pretty bullish for equities as the DXY falls. So I don't know if you remember, Peter. I think last week or the week before, like I'm looking at the dollar going up, and I go, look, if the central banks want the dollar to come down, they can make it come down. They can cut interest rates or forward guide that they might cut interest rates. They can do swap lines with other countries. They could do all. They could use a bully pulpit for the administration to cause the dollar to go down. The dollar's going to go where the banks want it, where the central banks want it to go, and it looks like down is the way. Very exciting. So, Peter,
Well,
how much of your total capital are you willing to put directly into the stock market? 90%, 100%? What are you willing to do?
0%. I don't like. I like crypto.
Well, your crypto, Bitcoin, look at that move. Look at that move on crypto, how it moved up. Let's go ahead to the 2-hour chart. This was the move we saw today. Just a beautiful, beautiful move. And we had that in all kinds of different assets. We had it in gold futures. We had it in, this is the S&P, almost to all-time highs. NASDAQ retraced 50% of its drop. So does the Fed want markets at all-time highs? Does a bird fly south during the winter? I think it's safe to say that that's what they want. We also saw bond yields, which had ticked up. It was moving suspiciously up over the last 2 weeks, gave back all those gains. So we have shorter term rates that are lower than longer term rates, which is what you want, and then all of them falling, which is pretty cool. Far cry away from the 0% interest rates we're all used to. Well, those of us who are before the before COVID, we're used to 15 years of 0% interest rates. Maybe we get back to that, maybe we don't, but we don't necessarily need that in order to get all-time highs as we are seeing. So, Peter, basically, don't look for the GameStops of the world aren't happening now, right? What we're seeing is like the NVIDIAs of the world, the AI boom. We're seeing altcoins and layer ones and Bitcoin take off. If you're waiting around for your NFTs to jump 3 times in price or whatever it is, if you're waiting for AMCs of the world or whatever, that's not the story. What's going on now? The story now is 0 DTEs, AI, and Powell losing the fight with the Trump administration and go ahead and cut rates. So is this the beginning of the last leg, the blow off top for the cycle? Stay tuned for more after hours as we dissect that week by week. But it looks like it. It certainly looks like it.
Losing the fight to Trump, I don't think Powell lost anything.
He had to give in. He had to go there and bend the knee at Jackson Hole and basically capitulate, going, hey, the Trump tariff inflations didn't happen. We didn't get a massive surge of prices.
Not yet.
The mass deportations helped to offset it. I don't even know if that's what they were thinking. I don't remember Scott Bessent saying this. Oh no, we're going to offset the tariff inflation with just completely gutting the working class, the working population of the United States. Obviously, why would inflation be a problem? We're going to deport tons of people. Say what you will about it. Shooting someone in both legs keeps them steady. Keeps them real steady.
I don't know about that.
Twice. It keeps people steady.
Steady is not the word I would use for that. Yeah. All right. So you told me that why would the Fed want to go against the president? Why would they be in conflict? They want to support whoever that president's going to whoever that president is. So why are they in a fight? And why was there a fight to lose?
Oh, you sweet summer child. The Fed is not there to support the president and whatever the president wants to do. No, 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 no. The Fed is there for full employment and stable prices, which is to say, whatever the government decides to do, it will do whatever it needs to do in order to offset that to have stable prices and what have
so
you.
they're not fighting.
Well, if
It's a
Powell
supportive
had cut
role.
interest rate, well,
It's
if Powell
like
had-
this. It's like in League of Legends, you go bot, right? And then you have your ADC, that's the
Nope.
president,
Nope.
and then you have support, all right? So you got your Lulu is like the Fed, and then you have Varys, who's Donald Trump.
Sure. Right.
I got it.
For the 1% of people who got that, congratulations. I hope Peter made your day. For everyone else, no. What Peter said was total nonsense and no need to look it up. No, the Fed does not want to seem partisan. See, the Fed here, the way that forward guidance works is that they have to thread this line. The Fed knows what the market wants priced in because the markets will price in future information in the options market, in the futures market, in the bond market, which are all bets in the future, will price it in such a way as to let the Fed know, hey, this is what we're expecting. If the Fed operates in a way that's dramatically different, too different than what the markets are pricing in, well, then the markets have to reprice, right? So if they need the market to certain places, the Fed sort of has to do what the markets are suggesting. All right, everyone knows this. No one really says it.
Wait, so when Trump tweets stuff out or Truth Social stuff out, is he doing a kind of forward guidance, trying to manipulate the population so that the markets do what he wants? Are they both doing the same thing?
Correct. Forward guidance, exactly. So Trump is making it clear that I want interest rates to be lower.
Mm-hmm.
And so I will do whatever it takes in order to get interest rates lower. And if that requires completely rejiggering the Fed, well, that's what I'm going to do. So depending on your confidence level as to whether or not Donald Trump will do this, it might make you behave accordingly. And so that's why he does that's why he's doing what he does. That's why he says what he's saying. But at the end of the day, the Fed has to be the one to actually raise interest rates. And so Donald Trump had this whole campaign. We saw it for months since he became president, where just hammering Powell, cut rates, cut rates, cut rates, cut rates, cut rates. I'm going to replace you. Cut rates. I'm going to replace you. There's problems with the board members. Need interest rates lower. Scott Bessent is out there, selling this idea that we have to cut interest rates. And the thing is, if growth is lower, the Fed has to cut interest rates. Like the Fed, aside from Trump, wants to cut interest rates when employment is suffering. Right. So when he wasn't doing it, it was like, hey, if Donald Trump wasn't saying anything, you would be cutting rates right now. That's why it seems clear to everybody that you're not cutting rates because of Donald Trump.
All right, but now you're the one who told me. You're the one who told me that.
Go ahead.
You're the one who told me that the Fed chair wouldn't be antagonistic against the president like that. That they don't care who's running what. They have their mandate, and that's all they care about.
Well, they would lose control of forward guidance. Let's say he cut interest rates in April. Tariff problems, he cuts interest rates. Then people would say, hey, you're cutting interest rates in order to support Donald Trump's fiscal policy and foreign trade. And he might say, no, I'm not. But like, well, you cut rates just when he was doing that. So that means the next time Donald Trump wants to do something, you're probably just going to do it anyway, like support him. So all of a sudden now they give control of forward guidance to the administration. So he had to wait as long as possible from the tariff issues, as long as possible before cutting interest rates. So to make it seem like he's not doing it because of Trump, they're doing it because of data.
This is why I don't understand. Why wouldn't Trump just stop asking for it? Don't make
Because
it
he's Donald Trump.
political.
He's Donald Trump, and he doesn't understand.
Well,
He
I
doesn't
mean,
seem
we
to
don't know
understand.
what. Look, how dare you? Shut your mouth. We don't know what Donald Trump understands and doesn't understand. All right, and
Well,
it's
we
not
know
just Donald Trump
Bessent
waking
knows
up in the
this.
morning and going on X or whatever. There are other people who are around him, advisors. Look, if Joe Biden ran the country for all those years with the support, right? The support ran the country, from what I understand. Then Donald Trump has that support too. So I will not allow you to denigrate the leader of the holy global empire. You don't know what's in his mind, but somebody must have told him, hey, look, if you just, Powell must have told him, hey, look, if you just, wait a couple 2 weeks and I'll cut it. Why not?
Well, I don't think. Well, we know Scott Bessent, Treasury Secretary. He knows all this.
Mm-hmm.
He knows about the interest rates. He knows about forward guidance. He knows how the Fed works. Whatever. This guy worked with all the big dogs. I think Druckenmiller, Soros, the whole thing. Like, he knows. He's part of that world. He knows. The fact that he was out there repeating Trump's line means tells me he couldn't get Trump to not say anything. That maybe Trump had said it, tweeted out, or socialed it out, or whatever, and now Bessent's got to go sell this story. So it was always going to be the case then, if that's true, that we just had to wait long enough that once the pain got enough and once the data supported the Fed in doing this, that they would go ahead and cut rates. So once we saw that inflation month after month after month was flat, and there's a surplus because of the tariffs, and we're seeing the effects of unemployment rate and all the different details of the initial jobless claims. We're seeing continuous claims. We're seeing the average hours worked. All the employment data is showing problems there, lower hiring, all that sort of thing. Then there was enough for them to be like, well, no, we are data dependent, and now we can go ahead and cut rates. So look, we're going to take a look at what can happen ahead. But for now, let's take a word from our sponsors.
Ask yourself this. Are you making trading harder than it needs to be? If you're trading manually or still coding just to connect to your broker, yeah, it's time to upgrade. TradersPost lets you automate trades using signals from tools like TradingView or TrendSpider or even your own custom setup. It works with brokers like TradeStation, Tradeovate, Coinbase, and a bunch more. I've been using it myself, and getting started was smooth. The platform's clean, setup's quick, and once it's running, it just works. And when you're ready to scale, adding more strategies, plugging into prop firm accounts, or juggling multiple portfolios, TradersPost handles it. It's built to grow with you. Start your free trial at TradersPost.io. Trade smarter, automate your edge.
All right, guys. Well, we're back here. You want to know the same thing I want to know. How do we bet now for the future? Now, when we're taking a look at these macro signals here on after hours, we want to pay attention to a few key things week by week in order to see how they change over time. That is growth, inflation, policy, global liquidity, and the dollar. These 5 things are basically your weather report for what's happening in markets. We already talked about growth and inflation. That growth is actually lowering for most of the economy. In fact, if you take out the Mag 7 from the S&P and you just look at the S&P 493 instead of the 500, the S&P has basically been flat. Right, all the performance gains have gone to the top 7 dogs in the bulldogs inside of the market, which means there is a problem with growth and earnings within the economy. We also know that one second here. We also know, so over here when we're taking a look at our growth, we're seeing here that in the ISM, this is the PMI, which is just a diffusion index showing the sentiment of growth within the supply chain. We've been seeing that we've been basically below 50, which is contractionary, for a while now. Since basically 2023, we've peaked above 50 for a little bit, but we've been below, which means there's been this overhang on growth for the economy. But on the other side, inflation has been up. Even though it's not skyrocketing at 9% anymore, a 2% inflation compounded year by year is still pretty brutal on the inflation front. So then the question was always what policy would be. And now we've gotten the information, the policy from the Fed here at Jackson Hole, which is we're going to cut rates, we're going to stimulate growth, we're going to try to get that engine going, and we're going to risk inflation rearing its head. And if it does, we'll raise rates later on. So that clears out. We know what the monetary policy is going to be. Sorry, the fiscal policy is going to be from the Trump administration. They've telegraphed quite clearly that they are going to do this America First sort of thing. They would rejigger the supply chain and bring that stuff back to America. We know what's going on with growth; it's failing. We know what's going on with inflation; it's steady to slightly rising. So the question now goes to global liquidity and the dollar. Now, global liquidity is the amount of dollars or the propensity for dollars to flow throughout the economy, and this affects credit, whether credit will be supplied. So, if we actually take a look at the NFCI, which is the National Financial Conditions Index that we can see here at the Fed, we can see here if we take a look over the last couple of years that the financial conditions, the stress has been falling, right? When this chart is falling, it means that there's more credit issuances, right? This is more liquidity flowing into the markets. Whether that flows to Main Street, well, it ain't. But it's flowing to financial markets. That's why we've had Bitcoin basically up 600%. Notwithstanding the recent dip, basically up 600% since October 2023. Stock market's at all-time highs and that sort of thing, and that seems like it's going to continue. So that's good on the financial markets front. But the thing that we want to pay attention to now, the thing I'm watching like a hawk, is the dollar. All right, if we take a look at the dollar here, let's just take a look at dollar futures so we can get some volume information. What we're seeing here, if we take a look at the daily, is that the dollar fell from January 2025, basically when Trump was elected, and it's been falling, and it fell down to a support area here at around 97. And we've been looking for that to break to the downside in order for the good times to keep rolling, or as Ken likes to say, les bons temps roulés. If we get a break below 97 on the Dixie, basically we get a lower low on the dollar, I want to be long equities and risk and beta, right? Bitcoin up, gold up. Gold might be a little bit iffy, but gold up, S&P, NASDAQ, Dow Jones, equities up, bond yields down. If the dollar breaks down below there. If it doesn't, and we get a rebound, and the dollar basically confirms this area of support and rises up, and we get a break above the recent swing high of 100. Sell it all, folks. Sell it all. Or do whatever you need to do in order to protect yourself against the downside, because that would be bad news, right? So it's interesting what's going to happen over the next couple of months. The next date we want to pay attention to will be September 17th, when the Fed actually not only cuts rates, which the market is pricing in, but also gives us more forward guidance of what's going to happen over the next quarter. That's the rough patch to watch out for, Peter. Stormy seas ahead, but it might be all-time highs as the sky darkens and we prepare for collapse of epic proportions.
Well, if I learned this from you, we need the only thing that's going to get the Fed to goose the economy is crisis on Middle Earth. I mean, we need a crisis.
We're already in crisis. That's why they're already telegraphing the cut rates. If they're doing this, remember, tilted to the downside, tilted to the upside, it means things are way worse. Whatever the Fed says, it's like way worse than that, right? What's the Fed rule? Everything's fine, everything's fine, everything's fine, we fixed it. That's it. That's the way they
Right.
operate. And so if they ever admit that there's ever a problem, it means the problem is ginormous, huge, right? We didn't go over that today, but Japanese yields are rising. The 10-year and the 20-year are skyrocketing. Money's being pulled out from the Eurozone because of it. We're having all kinds of stresses throughout the world. Things are pretty bad, and they've been doing things behind the scene in order to try to goose things up. The reverse repo is the lowest I've seen in forever. Issues with the Treasury General account. Look, all the words that Peter doesn't really understand. Suffice to say, there's problems there, and so if they're cutting rates, it means that that things are bad. If they're even suggesting that they're going to cut rates, that things are bad. So we're already in crisis territory, and I think they want to front run missing it because of how so badly they missed inflation last time. So we'll see. We'll see what kind of Fed we have, but it seems quite clear that the Fed put is in full effect, and all-time highs will continue until morale improves. Peter,
Good news?
anything else you want to cover before we let it go?
Well, is this good news? Is it bad news? I'm kind of confused. You make it sound like it's great
Good
and
or
then not
bad?
great at the same time.
Stop with the good or bad.
Should I be happy?
If you're exposed to markets, yes. If you're not exposed to markets, absolutely not.
Okay, so not a good time to quit my job?
No. Oh my God. Now is not a good time to. If in case I haven't made that clear, employment bad. Market's up. Employment bad. Market goes up when bad things happen. Market goes up when bad thing happens. Market goes down if good things happen for you. Let me put it a different way. If the gap between the rich and the poor ever narrows, so does the profit margin on the S&P. Okay? All right? Is it good for that distance to be large? No. But also yes for portfolios. So you got to, Peter, I'm trying to walk the line here. I don't know how to do Fed speak specifically, but it's like, hey, I'm glad my bank account's at zero because now I can use my credit card. So that's sort of idea. My credit card limit is a way higher limit than whatever I had inside my bank account. You get the idea. Let's just go ahead and wrap this up. Guys, that's it for After Hours for this week. If you enjoyed the show, please leave a comment inside on YouTube. It helps us grow, helps us get to more people. And the bigger we are, the more I can get like known people, famous people onto the show and ask them questions in the standard TradersPost panache. So like and subscribe and leave a comment if you will. We'll be back next Friday at 4 p.m. Eastern Standard Time for even more market shenanigans. But until then, we wish you, as always, a happy trading.